All right, hello and welcome. Thank you for having us today. We are Mount Sentinel Capital Partners. We will be providing you with a fund status update. But first, allow me to introduce the team. Carson Goldman, I'm your fund manager. Joining me from left to right, we have Ian, Alex, Travis, Fukong, and Andrew. First, an executive summary. A bit of a roadmap of where we plan to take you today. So we're going to give you the overview, refresh you on what the fund goals are, then talk about the property. We'll take a step back at that point, give you some macroeconomic analysis, some of the factors driving our decision making today. Then we'll take a deep dive into some of the numbers. We'll talk about the different possibilities, and ultimately provide you with a decision, recap, and justification. So we are, of course, an evergreen fund, targeting those core plus returns at the 11 to 13% mark. We are managing $3.25 billion in gross asset value, and we have caps on both our loan to value and the amount of equity that we place into development. Now the property, this is the whole reason we're here today. We have a 200,000 square foot office building. It's currently occupied by a single investment grade tenant. Now we're talking about this property because ultimately it's going to become a destabilized asset. While there are 3 years left on the lease term, they are not physically occupying the building. So what does that mean for us? Well, we talked about either potentially terminating the lease, and they have talked about potentially subleasing. So we are here today to figure out what to do with this property. Now we have three options. One, disposition the property, take the proceeds, and invest them in alternative assets. Two, hold the property, continue to operate as office, find a new tenant to release to. Or three, a life science conversion. And that's what we'll be trying to pursue today. As taking a look at our stoplight chart here, you can see on the far right side the potential we have to bring office back to life. While it's a little bit outside of our swim lane in that this is a value add risk project, it does offer opportunistic returns at that 18% levered IRR mark. And so those strong risk adjusted returns are the reason to pursue this project. Now, we don't make decisions in a vacuum. We like to consider macroeconomic factors in the headwinds and tailwinds of today. I've been hearing a lot about inflation, and now I'm too young to remember that, but looking at the stage, Travis looks old enough. So, Travis, do you mind telling us what's inflation and how does it affect us today?
Thanks, Carson. I appreciate that. Let me put it to you this way. How much more expensive is a hair tie for your millennial man bun today than it was a year ago? We're living in an inflationary world, buddy. For the last 13 years, the Federal Reserve has massively expanded its balance sheet in an effort to revive the U.S. economy from both the great financial crisis and COVID-19. In the process, they've primed the pump for what we're seeing today. Last week, we saw a year-over-year CPI change of 6.2%. That's the highest inflation figure we've seen in over 30 years. Now, often our clients are sending us emails with these headlines and calling and asking us, is real estate an inflation hedge? To which we answer, yes, absolutely. Here are the wiring instructions. And it is, from both an income and a value perspective. From an income perspective, if you think about the lease types, triple net, think percent of sales, tying rents to CPI changes. From a valuation perspective, think about the replacement cost. As labor and materials become inflated, your value of that performing asset also is somewhat insulated. Now, no asset class is immune to the effects and the forces of macroeconomic supply and demand. If you oversupply a market, no matter if we're talking about paper clips or office buildings, that asset is going to depreciate over time. Now, that's what our main concern in this market is. We're worried that this office MSA is becoming oversupplied. And if history is any judge, office is going to underperform its peers in industrial, retail, and multifamily from both an income and a valuation perspective. So if we're right that inflation is on the horizon, and if we're right that the office MSA is becoming oversupplied, then now is the time to revisit this asset and consider other uses. Now, we don't make any decisions in a vacuum, and we don't know where this monetary policy expedition is going to end. We don't know if inflation is here to stay, so I would recommend we take a deeper dive into the market.
Thanks for breaking it down in terms that me and my millennial friends can understand. All right, well, that's not the only macroeconomic storm that we're weathering here today. Ian, can you talk to us a little bit about how COVID is still affecting the market?
Happy to, Carson. COVID has accelerated the existing trends we've already been monitoring within the real estate industry and has reinforced our investment decision to target asset classes with long-term, strong real estate tailwinds. That includes industrial and multifamily. Currently, we have less conviction with regards to office, as it's still recovering from the pandemic. One sector that has gained more attention from our research department is life science. We currently have minimal exposure here, so there could be an opportunity. There's been significant investment in life science since the pandemic. However, this industry has been growing substantially over the past decade, mainly due to technological advancements in medicine, as well as demographic trends such as an aging population. The percent growth in workforce in life science has far surpassed that of total employment, spurring demand for lab space in prime real estate markets such as San Francisco, Boston, Los Angeles, and Seattle. These properties are raking in some of the highest asking rents that have grown 50% since 2015. Given these positive market indicators, life science is a very attractive asset class, and through conversion could make office more sustainable and mitigate the risks inherent in that asset class. So Carson, in total, industrial and multifamily are performing very well, and life science conversion could bring office back to life.
Thanks, Ian, for that economic breakdown. Okay, well, it sounds now that maybe the best option is to disposition the asset, take the proceeds, and put them into one of these asset classes that you just described as liking so much. But Alex, you're in asset management. What do you think?
Great question, Carson. Let me break down what that would actually look like. Essentially, what we would be doing is we would be selling off our office asset and realizing between a 9 to 10% IRR. Then we would take those funds and reinvest them in multifamily and industrial assets that we forecast to return between a 10 to 11% IRR. Now, this does check the box of investing in core plus income-oriented assets. However, it doesn't quite reach our threshold for our IRR terms, so we've decided to sunset that opportunity.
That makes sense. We've got to trust the numbers. Okay, maybe the next easiest option, though, is to continue holding it as office and find a new tenant to whom to lease.
Another great question, and that's something that we've already looked at as well. The way that we decided to look at this is as if it was a brand new investment opportunity. But what we found was that the return profile was not strong enough to compensate for the risks inherent in this asset. Now, the first thing is the massive releasing risk. We currently have a single tenant who has communicated that they are unlikely to release after their 3-year period is done in 3 years. Now, this is even more concerning given the fact that they're occupying all 200,000 square feet and that our debt will be coming due 2 years after they would be vacating. Another big thing is that we are concerned that the market is moving away from us. We currently have 87% occupancy, increasing inventory, and 2 years of negative net absorption. Now, given the fact that we see another 6 million of inventory coming online within the next couple years, we think that it's actually very likely to see that negative net absorption trend continue. Now, as you can see from this, even if all of our variables end up turning the way that we want them to, we're still not going to be able to return the right kind of proceeds for our fund. As you can see, if we even just underwrite a 6-month lease-up period, which I think is a very liberal assumption, we're still only going to be achieving a 10.6% IRR, which does not hit our threshold for the fund. So we would recommend not to pursue this opportunity.
Got it. Thanks, Alex. Well, I guess that just leaves us with a conversion opportunity to life science, but Andrew and Fukong, y'all are on the redevelopment team, so what's that all about?
Thanks, Carson. Let me jump in there. And dive into how we can bring office back to life. Now, we're very fortunate to have an outstanding office to life science conversion opportunity on our hands in a top 5 life science cluster market. Now, this project would involve an 18-month redevelopment, ultimately delivering this product to the market in the first half of 2023. So let's dive a little deeper into the benefits as well as the risks through our SWOT analysis. Now, the key strength we see with this project is ultimately the strong return profile of an 18% IRR, which is much more in line with an opportunistic type of return, considering the risk profile that's very much in line with a value add type of strategy. And that can be attributed largely to the rent premiums we're seeing in life science over office. Now, turning to the weakness, ultimately the weakness of this project is that of any conversion project. We're going to be competing with built-to-suit projects that simply might be a better fit for some tenants, so we need to be cognizant there. turning to the opportunities, this is an area where we feel very strongly. We've got a great opportunity in this life science market with 99.5% occupancy currently, and we're able to deliver in the first half of 2023 ahead or with 80% of the current supply pipeline. Now, turning to the threats, ultimately the big threat here is the unknown. And there are demand uncertainties in this market. Absorption is not a very robust statistic for us. There's not a lot of historical data. So we've had to turn to other demand metrics to understand the demand picture better. And we'll dig a little deeper momentarily. Now, first, let's get a little bit more into the conversion considerations. And we need to understand that an office to life science conversion is not a no-brainer. There are some factors we need to consider. First of all, design considerations. So office and life science properties and projects are different. The tenants are looking for different things. While we've gotten great feedback from the experts that this is a ready-to-convert type of property, we need to realize that our property, even in best case, will not be a perfect fit for every tenant. Turning towards location, we feel very strongly about this location. We're in the heart of a life science cluster. This is exactly where our tenants would like to be. Beyond that, built-to-suit competition. Now, we need to realize that there is a pipeline of built-to-suit properties, and some of the tenants may simply just feel better alignment with some of those built-to-suit projects. So what does all this mean? What that means is we should not expect or underwrite the highest end of the market rent range for life sciences, and we should realize that we're probably going to have some disadvantage on the cap rate, potentially about 20 basis points. Now, turning to the demand picture. Now, once again, absorption is not the best statistic for us, but there are some other places we can turn. Demographics tell us that the part of the population that consumes the largest amount of life science products is getting larger. Our friend Travis and his peers are aging into that group every day. With that being said, there's a strong demographic story. On the funding front, it's been an absolutely gangbuster year, and there's a strong track record. In 2020, even during the pandemic, we hit new records of $250 billion invested. Finally, on the job growth piece, this part of the office tenant sector has outpaced all other office types of tenants, and even through the pandemic. So overall, we see a very strong secular tailwind for the demand story in life science. Okay, so we have a great opportunity here. Let's look to the joint venture. We have a great partner on our hands in this joint venture partner. This is a sponsor in the market who has local expertise, has significant ground-up life science development expertise. It's exactly the type of partner we'd like to do business with. That being said, we see some risk on the alignment of interest piece. So we've addressed that through our term structure, and we've countered the sponsor's proposal in two ways. First of all, we're looking for a 5% minimum equity stake from the sponsor, and we think that much better aligns their interests as an equity partner as opposed to a fee developer. Now, the other piece is the promote structure. And we've countered with what we see as a reasonable 20% over 9% IRR pref, as well as an additional tier of a 30% over a 14. And we think that will drive this partner to get our funds returns, or to meet our funds returns of 11 to 13%, while also rewarding the upside for our partner. Through this, we think we can really achieve a win-win between ourselves and the sponsor. We're excited about this opportunity. But let's turn to the financials to understand a little bit more. Fukong?
Thanks, Andrew. Now time for some really exciting numbers. As you can see here, again, bare, base, and bull analysis. Even the base case looks attractive enough. 20% project level IRR, 170 basis point of development spread. And as LP, we're getting 18% return and 1.8 equity multiple. We're not even mentioning the bull case. Now, the bear case might look a little bit concerning, but we can definitely tackle those issues when the trouble happens. Now, how do we get those numbers? Of course, by inputs. You might say, oh my God, this guy is presenting us so many numbers. Don't worry, we're going to deep dive on the most important ones. Cap rate, definitely one of the metrics we're looking into. We have all the 4 comps listed here, but are they all good comps? The answer is no. Comp 1 is totally empty at the time of sale. It's out. Comp 3, by definition, it's not even a life science building. It's only a 50% life science. It's out too. Comp 2 and 4 are going to give us the best estimation for the interim cap rate, which is 4.15. And we're adding 10 basis points for each year of holding. That's 4.55. Now, base rent, $70 may look at the higher end of the market rent. However, thinking about all the strong tailwinds and demand for the life science industry, just addressed by Andrew and Ian, And also thinking about the inflation, which Travis and Jake just gave us a great education on as millennials, $70 is actually conservative. And on top of that, we're also offering a general 6 months of free rent to support our tenants to help them financially when they're just moving. Now here's the illustration for the two variables I just mentioned about. As you can see here, only the worst case scenarios are going to give us a return slightly less than 11% IRR, which is the lower end of our fund's goal. And one other thing I want to emphasize is, even for a most bullish case, we're assuming a sale price per square feet less than that of Comp 2, which is 60% bigger than our property in size. Now we also stress tested some other variables. Construction, definitely one of them. Many things could go wrong during the construction. Personally, as a former structural engineer, I can't tell you how many unexpected surprises I have ever met during my engineering career. So let's be prepared. Vacancy, many of our tenants, they could go IPO in the next few years. They could go lights out. We don't know. Let's also test that out. Now, we also have some architectural layout issue like Andrew just brought up earlier. So let's also stress test the free rent period and also the lease-up period. Fortunately, our property is going to perform well, even with the fluctuation of all the 4 inputs we just go through in the past 2 slides. Now, as a conclusion, this is an appealing opportunity, high return. It also has risks. And this slide is not trying to scare you away. Instead, we're trying to show you we can tackle them. Of course, we're happy to take the risks with attractive return. At the same time, we can do a lot of mitigants. For example, we can sign completion guarantee with our development partner to tackle the construction issue. We can seek pre-lease opportunity. We can offer more free rent if necessary to tackle the lease-up risks. We can also do ESG upgrade if it's necessary to make our building more attractive. So rest easy, watch your money grow, and watch us bring the office back to life. Back to you, Carson. Hope you're also excited.
Thanks, Fukong. Who couldn't be excited by those exciting numbers? All right, so let's give you the recap here. We talked about option 1, disposition the asset, take the proceeds, put them in alternative investments. Ultimately, those returns just didn't quite hit the benchmark for our fund's goals. Then we covered option 2, hold the property, keep it as office, and find a new tenant. However, the amount of lease-up time that had to be underwritten there was either too aggressive or ultimately tanked out on the financials. Lastly, we talked about a very appealing life science conversion opportunity, a great way to potentially bring office back to life. Now, circling back to our stoplight chart, yes, we're a little bit outside of our swim lane here, a little bit more aggressive in getting those opportunistic returns at that value add style risk. However, we think the risk-adjusted returns more than justify that decision.
Carson, let me actually jump in there really quick. It sounds like what I'm hearing you say is that you like the opportunistic returns that we're getting at a value add risk, but that it might be a little bit out of our swim lane for a core plus fund. So I'm wondering, would it be possible to, as well as invest in this redevelopment into life sciences, at the same time also invest in this slightly more conservative income-oriented assets that I talked about earlier, thereby balancing out the risk in the portfolio?
It's an interesting idea, Alex, and I think I like that actually, especially in the context of we're potentially getting an additional $200 million from this institutional investor. This money is going to have to go somewhere. So I like that. Let's continue to pursue the life science conversion opportunity and get that additional return for relatively lower risk, and then mitigate the entire thing by packaging it with some of those alternative investments. And would you look at that? It really helps align our fund goals if we do it that way. This is a great way to bring office back to life. Thanks. We'd love to open the floor to questions.
We're going to definitely do multi-tenants because we understand on the market, many of the tenants are either between 15 to 30,000 square feet, and we're having a floor plate of 50,000 square feet of 4 floors, so we can definitely fit that. That's more of a, so my understanding of the question is more for how do we adjust the floor plate to putting the tenants, and I think that's a good question for architect friends who can easily fit in all the drywall. Personally, as a structural engineer, I work with a lot of architects before. They have great passion. They're so creative. We believe they can get this done.
I can jump in there. So we calculate our basis at $925 per square foot, and the average for built to suit is $1,075 in the market. So that was also attractive to us, and we think is an appealing reason to pursue the project.
So the base case for life science conversion is $70 per square feet. That's the base case. And that's definitely some premium on top of office, which is 57.5. So we're having $12 per square foot of premium for rent. That's why we're more leaning towards the life science conversion.
The top end of rents that we were seeing was $72 per square feet. Now, that being said, we were fairly conservative in terms of, we took a discount from there, and we also offered more concessions in terms of free rent. So although we were close to that top end, we feel like between the overall package and ultimately the effective rent, we are in the right place as far as that comparison from built to suit to our conversion. So our perspective on that is that we know the sponsor is going to be rewarded as an equity stakeholder, but they're also going to be doing the work. And we believe there's work involved to get the job done, and then there's also the value creation process from an equity perspective. So we weren't necessarily, we're looking at them as earning the profit for their organization from the equity. The development fee, the purpose is just to compensate them for their real costs in doing the job.
Thank you.